Thank you so much for tuning in. Welcome back. Welcome back. Welcome back. You know what it is. It's Jeremiah, England Bokers. I have our first guest here today. This would be the man, the myth, the legend, the lender. Kevin, is it Silver?
Sliker. Yep.
Sliker. Kevin Sliker. And who do you represent?
Movement Mortgage.
Movement Mortgage.
Yep.
And this is located...
My office is in Corvallis, Oregon, but we have offices from Portland down to Grants Pass, and Bend. Yeah.
Okay. And how long have you been a lender?
We're going on 7 years now. Been with Movement Mortgage for probably 5 of those.
Okay. So that's a long time to be out here.
It's it's your 10,000 hours, I would say.
Okay.
Yeah.
So then would you consider yourself a loan officer, or is that different from a lender?
So it's terminology. Loan officer, lender, mortgage lender, like there's a bunch of different terms.
What's the difference between the guy and the dude?
Yeah, I guess. I would say the one thing that people don't know is what we call a black belt in lending is when you've done 100 loans. Okay. So after you've done 100 loans, you have a black belt. That means you know enough to be dangerous. You've been around the block. You've seen it all, kind of. Okay. So
you're like, I've got 550, and you're like, we're going to give you to Kevin.
I've got at least a first degree black belt.
Okay.
Yeah, at this
so you've done at least 100.
Yeah.
Would that be child's play for you? You're like, I can crack those out after that.
I think it's important to do a bunch of different loans too.
Okay.
I started out as an assistant, and that would be the best way to go. I think starting out in the lending industry, just coming in cold turkey as a loan officer, you're probably going to fall flat on your face. Being an assistant, working under somebody, kind of getting your reps in, even though you're not like putting your stamp on things, that's the smartest way to enter the industry.
So let me ask you this. I'm a young cat. I'm 28 years old. I've never had a loan for over $50,000. Mm-hmm. Would you say that being a lender and what you do specifically is to judge people based on their credit solely?
No, not to judge. There's no judgment.
Okay.
Our job, I would say, is to present you in the best light. So think of us like an attorney, right?
So then you're not against them.
No.
Okay.
Like the underwriter is like a judge.
Okay.
Right? They're going to say approved, not approved. Our job is to put your best foot forward when you're in front of a judge.
Okay.
That's the kind of.
In case you guys can't tell, I'm going to grill the shit out of this guy.
Yes.
Because I don't know anything about what he does. I should, but that's not my job. I'm a realtor. I realtor.
Yes. So. It's good. It's good to know enough about the other person's side of the transaction, but this is the point of working with good partners. You don't want to know everything. It's too much.
Interesting. All right, let's get into some more controversial questions here.
Yeah, let's do it.
First one, I hear this one all the time, is buying a home actually cheaper than renting? As a realtor, I think it is, but there's a lot of stigma around this question. I talk to people all the time, like it's expensive, and I see often when it gets back from the lender, like I talked to Mike, I'm sure you're familiar with Mike. He's also cool shit too. But we're talking about Kevin right now. It gets back from him and it's actually, it pans out to be usually quite the same. Sometimes it is, depending on their credit, it is, much higher. Yeah. But what do you think personally in your experience as a black belt?
I think to take a step back and look at like where these things come from, it's always kind of like a consider the source. So the studies have been done, the research is there. If you're living in Miami, New York, Hong Kong, London, it's definitely going to be cheaper to rent. Definitely cheaper to rent. But if we're talking about local specific place like Albany, Oregon or Gresham, the reason you hear people say it's better to buy, I don't know if it's cheaper, but if it's better to buy than rent, it's because homeowners have like 40 times the net worth that renters do. Okay. So that's where the incentive is to push people to say, hey, you should own a home. But typically your mortgage payment, especially where rates are now, your mortgage payment is going to be higher than what you're paying for rent. Okay. The whole point of this is like people say, well, when you rent, your interest rate's 100%. Yeah. Right. You're just blowing money.
It's going into anywhere. A hole somewhere. Or usually it's a hole in someone else's jeans. That's where it's going.
Yeah. And for, a homeowner, it's expensive and it's maybe hard to make that mortgage payment, but you're paying yourself. Yeah. A part of your mortgage payment is principal that goes back to you. So it's in your best interest to own if you can. That would be my answer. But
if I have student loans, does that automatically kill any chances I have of owning a home?
Yeah, it does not. And a lot of people think it does. A lot of people.
So this truly is a myth.
It is, yeah, totally a myth. I mean, you think doctors have $300,000, $400,000 in student
Yeah, no,
loans.
100%.
They make a lot of money. I get that. But it's like,
not anymore.
But they got to pay off those student loans. They still buy homes. So yeah, student loans are definitely a part of the equation. But with income-based repayments or a lot of people have graduated payments. There's like a lot of deals to be had on how you set up paying back those student loans. Lenders only look at the monthly payment. So a lot of people say, well, like I have $60,000 in student loans. I probably can't buy a home. We don't really care what your balance is. The only thing we care about is what you're paying on it. So if you pay $220, if you pay $220 a month, we just care about the $220 a month. We don't care if it's $80,000, $90,000, $100,000.
$8 million. If you're paying $15 a month, your DTI is still looking good. You can swing it back.
Yeah, you could have $1 million student loan balance, and if you paid $5 a month on it, we would go off the $5.
Wow. You heard it here first, guys. You're a student. Stop using it as an excuse.
A corollary to that is the thing that I believe hurts people's qualification the most would be auto loans. The average car payment in America right now is over $800. I was
going to say, I thought when I was a salesman, I'm a realtor. When I was a salesperson, it was in Washington State, it was $570. That was 4 years ago. That should say something. Things are getting more expensive. Wink, wink. Not just cars.
$500 a month, $500 to $800 a month probably buys you $100 to $150,000 worth of home.
Oh wow!
So that's how much it can impact your approval.
Oh my gosh! So then it's really the difference between having a home that is like not a fixer and a home that is going to need a lot of work.
Yeah. I think it's the difference between kind of like how life creeps in on people. A lot of people, they get a job out of college, they have their roommate's furniture. They kind of want that better place because they're trying to impress their significant others. So they buy new furniture, and then they have the old clunker car from high school. It got them through college, but now they want the new car. So they go and get the new car, and they have the good job to be able to afford those things. But then one day they say, well, now I want to buy a home. And it's like, well, because of the expensive apartment and the expensive
car, you set you up with a DTI that doesn't
kind of shot yourself in the foot.
That success.
Yeah. Best advice I got was live like a college student as long as you can outside of college.
100%. 100%. That's actually really interesting that you put it in that aspect, because a lot of people do fall into that pitfall. I see that happen a lot of times. People are trying to impress people that don't exist.
Right. Yeah, that's
you're trying to impress people that don't exist. So if you're listening here, don't buy that car. And if you have to, if you absolutely have to, right? Because if you live in Portland, like we're out here in Portland right now. If you live in Portland, you really don't need a car. But if you do get a car, I like to drive. I don't like to walk. I'm fat. I'm lazy. I get it. So get something that's affordable, man. Get the good.
Nobody cares what kind of car you drive.
They don't care. They care that you can drive, because most people here can't.
True.
Okay, let's move on here. Oh man, are FHA loans only for people with bad credit?
It's a really good question. I think FHA has a old sort of stigma that's still there, and it's because FHA, by and large, would resonate with people who would call it like a subprime loan, right?
Yes.
So like the old bad loans of 2008 and before, 580 minimum FICO, like kind of stretching debt to income ratios. It's a more forgiving loan program. So people would say it's a more risky loan program. I mean, you're not wrong, but there's mortgage insurance there for the life of the loan. So
there
it's
is
safe.
Some inherent risk.
A little bit,
with the
but it's like
loan.
not our problem, right? And it's not the client's problem. That's
the government's problem.
Yeah, exactly.
They're taking a risk on you.
Pretty much. Yeah, that's the way I would look at it. I don't think it's worth necessarily going crazy trying to, get into a conventional loan. One of the common situations for switching to FHA from conventional, so some people would say like, well, why would I do that? If you go conventional and you have good credit, not great credit, not bad credit, just like mid credit, your MI going conventional could be $300-$400.
Okay. And for the people listening,
MI, mortgage insurance. Okay. So if you have less than 20% down, you have private mortgage insurance on a conventional loan. And that protects the lender in case you default. Okay. So just think of it as like an extra tax on your mortgage payment because you didn't have 20% down. Okay. So if you go conventional, based on your credit score, your MI quote could be $300, $400. If you go FHA, it might be $150, $200. Okay. So sometimes when we go FHA, it's not because you're a bad client, you got bad credit. It's just like a better financial deal. Okay. And for the
Which
longest
is
time.
where the lender comes in to be like, this is going to benefit you. Do you have people who fight you on that, who are like, no,
We do, yeah.
we're not going to?
It just takes a little bit of education. Yeah. And I think before conventional had a 3% down first time buyer program, their minimum down was 5%. So if you had less funds, we would go FHA. So only 3.5% down.
Interesting.
Yeah.
It always fascinates me. I'm talking to these young people. I've got a lot of young people reaching out to me right now. If you're one of those young people watching right now, thank you so much for
He's
reaching out.
talking about you right now.
I tend to work with people under the age of 40. That's not like my cutoff or anything. It's just the people who reach out to me who are, they're into the world is scary right now. And so they're out here trying to take a risk. They're like, I've got bad credit. I'm a student or whatever it might be. And they're willing to take that risk. So it's interesting to me that people would get in there and then fight you.
Yeah.
It confuses me.
If people come in and try to fight us, again, it's just education. A lot of times people have these antiquated ideas of what's going on. Their aunt, their uncle, their mom, their dad kind of told them this is what I did, and that's not necessarily wrong, but it doesn't apply.
Of course not. Yeah, but that happened 15 years ago.
Right. Like my grandmother, she's retired now. She worked at Johnson & Johnson her whole life. She bought nothing but Johnson & Johnson stock, right? So she's living high on the hog, but if I were to ask her, like, hey, what should I do to be successful? She would say, go work at a company, work 20 years, get a pension, retire. I was like, okay, but like that's not realistic in today's world, right? It's never going to happen. Right?
We might not make it.
She's not wrong, but like neither am I for saying that that's not a legit way to go. So yeah, I think it's important to like understand where people are coming from and not be butting heads with them, but showing them the path forward in today's world and today's landscape.
Of course. Yeah, that's the biggest thing that I've learned as a realtor, to not be abrasive.
Yeah, for sure.
Because I'm like, man, I'm just trying to help you.
Right.
You asked me for help, and I'm telling you how to help, and you're like, absolutely not. I'm like, well, then why'd you ask?
Exactly. Sometimes
it doesn't help me to lie to you.
For the viewers, I get asked this as a lender all the time. People will say like, well, how do I know if I have a good real estate agent? And I tell them, your real estate agent is good for you if they tell you what you don't want to hear.
Yes.
I would always kind of
agree.
Stay cautious of the agent that's like, if you love the home, I love the home. If you want to do it, I want to do it. If you like that, I like that. Because they're not really advising you. They're just pushing you to get into something that might suck. Like it might be a home with a lot of work or whatever. And I
imagine if you didn't know anything about Porsche and your Porsche salesman is like, yeah, no, you can go ahead and get that Porsche. It's great, but it already has a blown out fuel pump. But they're not going to disagree with you because they want the money.
Right. It's like you don't want a yes man when it comes to real estate.
That foundation has cracks in it. I know you love the house, but that's going to be a problem. Let's look at something else.
Yeah, totally. I think for your money, we could get you into something better.
Of course.
It's like, all right.
I think that's a fantastic answer. It's a fantastic answer. So is it true that you can't get approved for a if you are self-employed, like myself? I've been self-employed for a long time. This is a great fear that I had when I was coming into being self-employed. I'm like, is this going to stop me from getting a home when I decide to go for it, right? Because I've heard it does make it extremely difficult.
Yeah. I think what self-employed people go through during the mortgage process seems more complex in some way, or maybe they just kind of like badmouth the process. But I would argue it's easier for people who are self-employed to get a home loan. There's a couple paths to self-employed homeownership.
Yeah.
The first, let's call it the traditional route, would be we look at your business returns or personal returns, however you file. Schedule C versus 1120S. Yeah. So we look at your business returns, personal returns. We look at the 2 years, the two most recent years. If income is increasing, we take an average of the two. If income is decreasing, we take the lower of the two. So we're conservative in both ways. Where people get caught up is they write off a lot of stuff because self-employed people don't want to pay taxes. So they made some income. Here come all the write-offs. Now I don't have any income. Therefore, I'm not taxed. That's great. You don't want to pay the tax man? Don't. Like, I get it. We all do it.
Taxation is theft. But also.
But when you're buying a home, lenders have to follow IRS tax code. Yeah. So if the IRS sees it as a loss, we have to see it as a loss.
The system is all set so that you have to go through the.
So you can't have your cake and eat it too.
They're like, hey, man, you can't be cheating us and then also cheating us. We're going to get it. If you want to get it, we'll give it to you. But hold on.
Exactly. So that's why people get kind of bent out of shape. Where I brought up the flexibility was if you want to buy a home and your lender's telling you, hey, we have this issue with your income. It's, an average of the two. It's not what you expected, whatever. You wrote off too much. Next year when you file, like maybe you file a different way so that you can qualify for more. Like a person who's W-2'd is going to make a cost of living adjustment, maybe get a little pay bump, maybe pay raise. There's no real variation from one year to the next. But a self-employed person can definitely restructure their tax situation in a way that moves their financial needle to get into a home. So I would say if you're self-employed, don't say, I'm going to buy a home right now.
Yeah.
I would say take 6 months to a year timeline and say, I think we want to buy this year, maybe next. Let's go get pre-approved. Let's do the tax return analysis and see where things stand.
Okay.
Now, if that doesn't work out at all, the alternatives, we have bank statement loans, which is a fantastic way to go. So that's kind of my favorite second option. So a bank statement loan would be, I look at your business checking account. I see how much money comes in. I see how much money goes out. And then we do an analysis on that to say, what's the net roll in your accounts?
Okay.
We look back over 12, 24 months, and that sometimes is a higher income amount than what your tax returns say.
And sometimes that's even the more preferable route.
Yeah. So it's
oh, you know what? This doesn't look so good.
Yeah.
So let's go ahead and do this.
For a recent client, we analyzed the tax returns. On paper, they made $700 a month, no joke. And I know they make more than that, right?
Yeah.
So we went with the bank statement loans, and they made $3,000 a month in income.
That's good.
That's the sway.
Yeah, that's a big swing.
Yeah, between what you can qualify for and what you can't. So
interesting. So if that just to be clear for everyone watching, did you say if you go with that second option that you can avoid paying taxes?
Not avoid paying taxes, but you avoid having to submit your taxes to the lender.
Okay,
the lender
makes
doesn't
more sense.
see your tax returns.
Okay,
so if you know you're heavy-handed
your
or your business is new and you took a lot of losses, try a bank statement loan instead of a traditional.
Or if you know that your taxes are kind of out of whack or whatever it is, and you don't want to deal with that up front. Let me ask you this:
your lender should be doing all of those for you, by the way.
So what you're saying is, if they're not, that's a shit lender.
Yes, if your lender takes 2 years of tax returns, well, see you next time. That's no good. You need to have a lender that has the product and can run the numbers and give you some alternative options.
Interesting.
Yeah.
Kevin, guys, check him out. Corvallis. And you can serve the greater area, correct?
I'm licensed in Oregon, Washington, Idaho, and California.
Okay, so then he can serve anybody listening on the that's
anybody
the West Coast.
Yeah.
This guy, I'll drop the name here.
Yeah.
I'm sure it's probably not actually where I put my hand at. I'm really bad at editing. Okay, so then when it comes to, again, self-employment, so then let's say I come in, I'm like, yeah, it's been a year, I done killed it this year in terms of bank statements, but I ain't paid my taxes. I'm not saying I haven't paid my taxes, if the IRS is watching.
Yes. Yes.
What I'm saying is some people go through this, they go through this. So if that was the case, can this person still also qualify for a home? Or will the government find you and stop you?
No one's going to come get you. There's no executioner, but there's not much you're going to get past a lender. We do all kinds of verifications on our end. So if you do have taxes that are owed to the IRS, we're going to ask you to pay it all or put it on a payment plan or do something.
So you have to comply.
Yeah. You can't be like, I want to buy a home and I just happen to owe the IRS $70K. We're going to be like, what are you doing about that?
Yes. Right. Oh, that's great. Yeah. So what's the plan on that?
Yeah. And it would work no differently than child support during a divorce situation. It's like, okay, I'm divorced. It's like, okay, well, we need the divorce decree to know if you owe anybody money. And it's like, you can't just
because you can't go swinging on that. That's now it's liable. Because now you're liable.
Well, yeah, it's like people have lied in the past, and it's like we need to know. We need to trust but verify.
Anytime there is a rule, this is always something good to go back on. Anytime there is a rule, it's because someone has broke it.
Yeah, totally.
And it affected someone heavily.
Being here in Portland, a prime example of that would be like, why do bathrooms have codes? Why can't I just go to the bathroom? Well, we'll let you figure that one out. Yeah, now we all need to know it's £7,294 to get into the bathroom.
If you live here, shout out Screaming Eddie for always walking around Safeway and screaming because you really put the Portland ambiance on for us, and we really appreciate you and your 6 blankets that keep you from exposing your genitals. We love you. We'd love you to death, and wherever you are, Screaming Eddie.
Portland fabric.
Yeah, 100%. He's a famous homeless person here. We love him to death. Yeah. Looks like a wizard, the man does.
We've got a guy, not homeless, but he's just got a long beard, and he's always dancing. We call him Dancing Mike. He's
100%.
Anybody who went to Oregon State knows Dancing Mike.
Love it, love it, man. Now, I have, and I feel like this one is going to be really controversial. Can paying off your credit cards hurt you, or does it help? Does it actually, because what I've heard is that it makes it better, like paying off that debt right before you make a big decision. will actually improve your credit.
Yeah. It will actually hurt your credit.
Okay. So then there is some credit to this myth.
The reason why is because the three biggest parts, and they're not all the parts, but the three biggest parts of how they generate a credit score for you is credit utilization, late payments, and credit history. So if you have a credit card from when you were 18 and you're now in your 30s, and you pay that off and close that out, now your credit history is going to be shortened up to whatever the last credit card was that you opened. So rather than having a 15-year track of good credit, now you have a 5-year track. So that's why your scores can drop, because you're deleting credit longevity.
So you've had this open, let's say, it was like $20,000, right? Out of $40,000, right? So you got 50% on there.
Yep.
You've had that open for 10 years. It goes down to zero. It's paid off. You go get that card is done. You close that.
You can pay it down to zero. That's different from closing it out.
Okay, so you paid down to zero.
Yeah.
Still open.
Still open.
Still good.
Still
you
good.
Hear that? Still good. We're still good. Okay, so it's when if you close that card,
yes,
and then open a new card, you've essentially said that chapter is done, and you have to start a whole new chapter, and the bank is going to look at this new chapter, not the old one.
Yeah.
Damn.
Yep.
Damn, you heard it here first, y'all.
Yep.
You heard it. Keep that Nordstrom card open.
Yeah. Like I had a card that I hated, and it had annual fees, and I had it since I was young. It was like one of those like you just get to put gas on and start building your credit. And now that I own a home, canceled it, got rid of it, but not a minute before. Yeah, it could shorten up your credit history, and that is what lowers your
Which
score.
could be the difference between getting that extra, what is it, 40, 50,000 or whatever it might be.
Well, yeah, credit score plays into everything. Plays into what loan programs are available, what your mortgage insurance premiums look like, and some insurance companies even use your credit score to dictate how much you pay for homeowners insurance. So
now, this is not to say that if you have low credit, you're completely screwed. But if you do have that mid-range credit, you could be shooting yourself in the foot.
Yeah, I would say at any credit level, don't do it until after you buy the home.
Okay.
Super simple.
Whether you got a 550 or an 800.
Yeah, just don't
hold on to that shit. Yeah.
Buy the home, then go shopping for credit cards.
Okay. Yeah. Oh, this is a good one. I want to ask this one. I want to ask this one because I hear this all the time, and as a realtor, it frustrates me because I feel like personally, I'm going to say my own personal opinion on this. So if I'm wrong, I'm going to look stupid as shit on the air. But I'm going to say this. I think it's better to just get in the game and buy sooner. Okay. But let me ask for everyone out there who is currently on the sidelines, like, I'm going to wait, I'm going to save up. Is it better to truly save for a large down payment liquid or just to get in the game?
Get in the game.
Get in the game. I knew.
Get in the game.
You saw me. You saw it. Roll it back. I'm going to roll this back 5 seconds. I said it. Get in the game. Yeah. Do not sit on the sidelines. You can't score from the sidelines. You can only score from the free throw. Yeah. Get up there and start taking shots because you might land one. You might get a damn loan.
You got to think about it this way. It's like you're less likely to save as fast as homes appreciate.
This is true.
So if you've got $5,000 and that's all you got, and that's enough to just squeeze you into a home, do it. Because the rising tide floats all boats. It doesn't matter what home you're in, right? So if you're in a yacht or a canoe, when the tide comes in, all boats float. Going up. If you're renting, you're treading water when the tide comes in. So it doesn't matter like how cool your house is, how nice your house is, how much down payment you have. Just get in. It's all about getting in. Then when your home starts to swell in value and you see that appreciation, you're capitalizing on all of that. We can always refinance you into better loan terms later. But trying to say, well, I'm going to save up to $50,000 so I have 10% down. By the time you hit $50,000, I promise you, homes won't be worth $500,000. They'll be worth $800,000, and now instead of 50, you need 80, and you didn't make it. You just can't do it fast enough. Now, if you have like, I'm living with mom and dad, and I can save crazy amounts of money, go for it.
Cool.
But the general average bear out there is going to be paying bills, paying rent, living life. You're not going to be able to save at a rate in which you can
absolutely
really
not.
Get
inflation
to the 15,
is ridiculous. Wages are also ridiculous. Everything costs an arm and a leg. Milk is like $4 a gallon. You're not if you are kidding yourself if you think that you are responsible enough in Portland. I don't know about Corvallis. I don't know if you because
Corvallis is pricey too.
It's not even just that it's pricey. It's that I'm talking to the people under 40, and you know what I mean? We're Portland sober out here, all right? We like to have a good time because it's hard to live out here. So if you are kidding yourself and thinking that you're just going to never go out and never spend $150 on some girl who's not going to give you her number.
That's true.
Or some guy, whoever it might be out there. I know we got some freaks in the city.
Yeah.
But, if you think that you're going to avoid that, you're just going to not hang out with your friends or whatever it is, you're kidding yourself. You're going to say, hey, I'm going to buy next year. And then next year's going to come around and houses are going to be too expensive again. And you're going to be in the exact same position you were when you talked to me or you talked to Kev and you said, I'll come talk to you next year. You're going to come back and we're going to be like, hey, how's it going? Did you save that extra 50? And you'd be like, extra 50? I thought I only needed 25. Well, houses are more expensive now. And you're like, damn, I'll see you next year.
Yeah. Yeah, I would say to anybody who says like, well, I'm different, unless you have like a genuinely extenuating circumstance, you're not different.
Yeah, you are.
People
unfortunately
just don't do what they say they're going to do. They kind of overshoot that. So yeah, I would say get in. We say the best time to plant a tree was 20 years ago. Mm-hmm. The next best time, right now.
Yeah, always.
It's the same with buying a home.
Always. If
the home makes sense, you like the payment, do it. Another saying that I love is it's not about timing the market. It's about time in the market.
Yes,
and that goes for equity, stocks, real estate, you name it.
Because equity doesn't start building until you start.
Let it do its thing.
You have to acquire it first. All that money in your bank, that's not equity, that's liquid. Yeah. Right. So it's not doing anything for you. Right. Your house, if you get the right one, is. So get in the game. You heard it here first from the lender, not from me, not from a realtor, right? Who's a salesperson. From the lender.
The math's better. Buy sooner than later. Yeah.
Yeah, of course. This is another good one. This ties into the last question I just asked, and this might even be a little bit more controversial because a lot of the people who might be watching this, I know that some people in my age group who watch this are 40 and above. A lot of you are 40 and below, but across the entire board, I hear this from everybody. Is it true that mortgage rates are never coming back down? Should we expect that they'll ever come back down to 2% rates now considered a legend? Is this ever going to happen? Is this ever going to happen again? Or should we just accept the fact that we have reached the new bottom and we should just buy in before the new bottom gets even higher?
Yeah. My vote is, get over it. This is the new normal. Doesn't do anybody good to dwell on what had happened.
Yeah.
Were 2% rates real? Yes. The lowest rate in my database is 2.25.
Oh, wow.
That's a good buddy of mine. Okay. Shout out to Nick. We did a VA purchase, then we did the VA interest rate reduction loan, and he locked in at 2.25, and he'll probably die in that home.
I can imagine.
Yeah, 2.25. It's a beautiful home.
You're not going to get better than that.
Hillsboro, you're just not going to get a better.
I'll get another house before I sell that.
Yeah, I think COVID was a black swan event. It was a one-time freak thing, and if you got in, you got in. If you didn't, you didn't. You can't say
I'm going to wait for the next world shutdown virus to come by.
COVID wasn't something that anybody saw coming. So it was a fluke thing. And it's not like the country is out to get you or the government's holding you back. There's nothing like that. It was COVID. The Fed had to do what they had to do. We in the mortgage world knew that this would be bad for us, for everybody. So
of course,
keep that in mind too. When the Fed was printing money and lowering interest rates from the Fed funds rate to buying mortgage-backed securities, which was lowering mortgage rates.
Yes.
We all said, this is bad. This is really bad. Yeah, it's a sugar high and we're all going to do refis and we're all going to purchase and we're all going to make bank. But the years after this are going to be just so
horrid,
bloody and gross. Yeah. And that's where we're at right now. So, they are a legend. It's a thing of the past. More people now outstrip how many people are below, 3%. People in the 6% range are starting to kind of,
tip the scales.
Yeah, tip the scales. So that's kind of good to see.
They're starting to, because that's the thing is that what I've noticed is the people who have these 2%, 3%, these are the people who are 50, 60, 70 years old in these $1 million homes because they've owned them long enough for them to appreciate to that point. The home might not be crazy nice, but it is worth, 1.2, 1.5 million because it is well taken care of and it's a solid home. And, obviously they're like, I'm never going to move out of this, you know? So, but those are few. And they're so few that people, because, people are not going to stop buying homes.
Yeah,
right? People have continued to buy homes. People continue to buy homes at these rates. And the people who have locked in their rates at, what is it, 6 or now that's coming down, we're into I believe the high 5s now. these are the people who are going to win because, like you said, it is a legend. It reminds me a lot of the same energy of when they were thinking about forgiving college debt.
Yeah.
And all of the old people were like, what?
Yeah,
I can't believe that you would.
Like, how dare you?
Why don't they have to pay it? I had to pay it.
Right.
So
It's true.
it gives that same energy to me
Yep.
that you're angry that you can't have something that someone else got at a time where it was it existed.
Yeah.
You know, if they were to be abolished, that this is just that time where this exists now.
Yeah,
and it was unfortunate for y'all.
Yeah,
but
if we could go back and do it again, sure. Like some people would do things differently, but I would say beware what you wish for. The people in the low rates can't really move, right? Like
this is also true.
So here's a fun fact on this too. So as lenders, we look at our database, all of our past clients, and we say, like, who could probably stand to benefit from a refinance? Now, this is where econ is. I'm telling you, it's cool stuff. I sent out like an email blast to everybody, and I said, you know, rates are in this range. Would you be interested in refinancing? Now, out of my past client database, who do you think is more likely to be interested in a refi? The people in the 7s and 6s or the people in the 2s and 3s?
Oh, of course, yeah. You're going to look. The people with the extremely high rates are looking to
They want to get out of
themselves.
that.
They want to get out.
Okay. What I found, and this could just be me, the people in the low rates actually reached out to refi.
Really?
Why?
What?
People in higher rates had higher mortgage payments, so they were very conservative. They didn't buy boats. They didn't buy RVs. For the last couple of years, they've been just making mortgage payments happen, and they're kind of like, hey, we're good. The people with the $1,900 a month mortgage payment were like, we got money to burn. So they bought too much stupid shit.
They went and bought the Mercedes.
Yeah. So now they're calling
me
to say, hey, can you refinance me and pay off all this debt that I'm getting behind on? Credit card debt, auto loan debt, whatever. My mind was blown. I was like, damn, this is kind of like a perverse incentive. Why would that be the case, right? So in my mind, I'm thinking all the people in the 6s and 7s would be like, yeah, let's rock and roll, lower my rate. It was actually a lot of my clients in the 2s and 3s saying, like, life got out of hand and I need you to restructure these debts. And so, like it or not, now those 2s and 3s are coming into the 5s and 6s.
Oh, so they're having to refinance.
Yeah.
And so a lot of these people, it's not even just that homes are being bought at a higher rate. More often, it's that these people who have made improper decisions with their wealth
Yes.
are now having to step out of that wealthy position because they have made poor decisions.
Yeah, totally. And it's like, so for people who are like, oh man, I wish I had a 2.25. Again, it's like, beware what you wish for. The person in the 2.25 is probably going to fuck it up.
To be completely honest.
To be 100% with you.
Because think about it like
It's
this.
statistically
What is it? What's the
likely to
old saying?
happen, you know what I mean?
Money changes you.
Yeah.
That's the old saying. Money, I've been affected by it. I was doing very, very well last year, and I was a very different man. I would call myself a boy. I was running around, flipping shit off, talking. It was the first time I ever talked poorly to a service individual, and that's where I realized. I talked poorly to a waiter in front of my friends, and one of my friends was like, "Why are you being a dick?" And I was like, the money changed me.
Yes. I
forgot where I came from.
Yes.
I was like, I forgot where. When you begin to forget where you come from, you got too much money. You need to check yourself.
For sure.
I had to check myself because now
wash some dishes.
I've made wash some dishes, I volunteer now, do all that type of stuff. It keeps you grounded. Never forget yourself. Don't sleep in. All right, Kevin.
Yeah.
Now, for those of you who have stayed to this point, we're going to reward you with some of the most controversial questions, the whisper questions. I'm going to whisper them to make them extra sensual.
These are serious questions.
These are the serious questions that will benefit you. So thank you for sticking around to this point. What is something lenders don't want people to know?
This is a good one. I would say you'll hear lenders tell you that you can't pay off your mortgage in less than 6 months. Ooh. So purchase or refi, they'll say you got to have the mortgage for 6 months. Usually 7 months, but 6
in
payments.
The car business too.
People have said that, right?
Yeah.
And what the lenders don't want you to know is that there's no prepayment penalty on your loan. You read your loan docs just like I did. You can pay it off as soon as you want to.
And there's no penalty.
Why do lenders say that? Because the lender, the specific loan officer, gets a penalty if you do. It's an old rule from the 2008 days. Lenders would refinance people over and over and over again, and it was called churning. So there's no net tangible benefit to you, the person who has the mortgage, but I would get commission check, commission check, commission check. I'll just refinance you 17 times in a year, right? Life is good. The reason why that rule exists is because they wanted to prevent loan officers from doing that, from churning.
Okay.
So now what they say is, okay, if you do a loan for somebody and you do another loan for them within 2 to 3 months, you're going to get your commission claw back on the
old
first
double
one.
deal clause.
You get,
it was
you
to
get
stop them from double
penalized
dipping.
for it. Yeah. So when you come to a lender from another lender, that lender you're leaving is going to be like, you can't do that. And it's because they don't want to get the penalty for it. I'm very clear with clients. Like, if you don't want me to buy groceries, screw me over, go for it. But I would ask that you hold on to it for 7 months, 6 payments.
Whatever it is.
And yeah, but that's a big one that I don't understand why lenders aren't forthright about it. It's an old rule. It's still there, and it's there to protect the consumer.
Yeah, of course.
But,
you don't want people double dealing.
I don't know
It's the same
why.
thing that happened
Lenders just
with realtors.
constantly lie all the time and say you can't pay it off in 6 months. And it's like, that's bullshit. That's not true.
So
There's
now
no
you guys know
prepayment
another
penalty.
one.
Yeah.
If a lender says this to you, and they don't then preface it by going, it will only affect me. Know that you can pay it off, but it will only make me poorer. The person who has done everything that they can do to serve you. Yeah. So do what you will with that information. If they don't say it to something to that degree, that's a shit lender, and they're trying to keep you on the hook. They're trying to mislead you. They're trying to mislead you. They did the same thing with realtors back when they called them optioneers in the early 1900s. Realtors would do with what's called now is wholesaling. They would take the person on, because back then you didn't have to have a contract. You didn't have to have a listing contract. You just had to have an agreement with them, and that agreement usually was on paper to some degree or whatever it might be. You would take that and then be like, hey, you know what? I want to sell my property for $170,000. Say, I don't know how they talk back then. I think that's how they talk.
Right. Something like that.
Something like that. And then old chap.
Right.
Yeah. Old sport. And they would take it to another person and be like, hey, this dude wants to sell his property for $200,000. Would you like to pay the $200,000? And the person would be like, of course, old sport. That's a great deal. And then he would take the middle and the commission from both sides. So he would take the commission, and the chaff between the 170 to 200,000. So they were getting triple dipped. Gotcha. And then eventually, these auctioneers were becoming extremely wealthy people. And they're like, how are all these people getting so damn rich? Like, where's all this money coming from? And they're like, oh, they're out here. So then the federal government came in and did what the federal government does. They said, hey, no more double dipping. And then they created the Realtors Association to keep people to the code of ethics, which is what we now follow to keep us from screwing you over in a situation where there's a lot of legal jargon where a layman's person could get confused.
It's very cool. I did not know that.
Interesting. Very, very interesting.
Well,
shout out to history. We got one more whisper question. This is and if you listen to this one closely, it's gonna help you out, right? So what is an insider secret in terms of lending that could save buyers, first-time home buyers of any sort, thousands of dollars?
The insider secret is, in my business, not much of a secret, because it's the number one thing I advise buyers to do. Okay. A lot of buyers approach buying a home like they do a car, a t-shirt, a hat. Like lower the price, haggle on price. That is the worst thing to do. In terms
to try
of,
and lower the price of your home before you buy it.
So if you're borrowing $400,000, the difference between borrowing $400,000 and $390,000, not that much.
Not much.
If you're gonna, go in with a $10,000 less offer, you're gonna shave $7 to $12 off your mortgage payment.
That's nothing.
Nothing. Doesn't even move the needle.
Completely negligible.
The savvy thing to do is to say, okay, offer $400,000 and put $10,000 towards my rate buy down. Ooh. Now, instead of a 6% mortgage, you're getting a 5% mortgage. And now you're saving $250 a month.
So you're still using that extra $400. So that instead of using that $10,000 up front to be like, hey, we're going to lower it off the price of the house. Yeah. We're now working on the back end.
Yes.
Work the back buy end. Down. And so it's still $400. Well, one, your house, the house sold for $400,000, not $390, right? Yeah. So you can always refer back to your house selling at a higher price. Mm-hmm. And also you're getting a lower rate.
Yeah. The order of precedence is like this. Like another simple example. Let's say you have $20,000. You use 10 for the down payment and you use 10 to lower your interest rate. Wow. That is 10 is like, let's say, the minimum down payment. There's no point in putting another $10,000 towards down payment. Again, it's only going to shave a little bit off the mortgage. But if you put $10,000 towards your rate buy down, you're saving hundreds per month.
Oh, man.
Now, stay with me. When you're writing an offer on a home, a lot of people like to lower the price. I say don't. In terms of getting the seller credit or the seller concession, for those of you who don't know, when you write an offer, you can ask the sellers to give you money towards your closing costs. And it's used holistically. It goes towards not down payment, but it goes towards prepaids, taxes, rate buy down, you name it. So when you write an offer on a $400,000 home, you can say, okay, Mr. Seller, here's $400,000. That's my offer. Give me $10,000 towards my closing costs.
Okay.
If the seller agrees to that,
I'll give you the full price offer.
They're going to net $390. So they're getting like a little bit of a ding, right? They're going to get $10,000 less, but you get to take the $10,000 and wipe the slate clean in terms of closing costs, or use all that money towards a rate buy down and save yourself like hundreds of dollars a month on the mortgage, i.e., thousands over the life of the loan. The order in which you should do this, and this is what I explain to clients, it's way easier if I use the bars and charts to like show you. It would be better to offer $410,000 and ask for a $10,000 credit from the sellers. That would be beneficial. The next best would be like offer 400 and maybe get 10,000. So it's like now you're starting to cut into the seller's net proceeds. And then the worst would be to just like try to negotiate on price. So there is a scenario out there where it's better to overpay than whatever the list price is by the amount you want back in a credit. So the seller is still netting 400,000. So they're not mad. They're like, sure, I'll give you 20,000, but you better pay me 420, not 400.
Yeah.
Right. So there's a way to make it work. But I promise you, even at 420,000, if the home's listed at 400, it's like, why would I pay 420,000? Well, you're asking the sellers to give you 20K. So
and you're likely eliminating any other offers at the same time.
To them, it doesn't matter because they net the same. They're getting 400,000, whether they give you 20 on the back end or not, or whatever. So the secret here is always, always, always negotiate seller credits, what we call seller concessions or seller paid closing costs. Never, under any circumstances, in my book, like would I say offer or negotiate on price.
Okay.
I think sellers get offended. I think sellers are emotionally engaged and attached to that price, and it's better for you mathematically, financially to get the seller credit. So don't even bother with the price.
Okay.
Again, you're borrowing 390,000, 400,000. Like who cares? It's a lot of money you're borrowing. So what would be better is to focus on what rate at which you're borrowing that money.
Okay. Now this is to exclude a home that is obviously, you've done a CMA on it and they're just asking a frivolous amount over what the home is actually worth.
Yeah.
You would come in at that and then still ask for seller. And negotiate seller concessions at all points. Never not negotiate them.
Yeah. I would say
if there's realtors watching this is to correct you from going, okay, well, no matter what, whether the house is priced $100,000 over what it should be or what, don't then go, let's meet them $100,000 over. Meet them at what it should be.
For sure.
But then also negotiate seller concessions. We want to make sure that if there are realtors watching this and they're young fledgling realtors, don't shit the bed by
that's true. It's a good point. If you feel like
buyer.
If you feel like you're looking at a home that's not properly listed, then I say write the offer to what you think you can get away with. Lower the price and get the credit if you feel like the price is truly not where it should be. But clients, for buyers, they need to basically know that mathematically it's better for them to get a seller credit than a price reduction. And realtors need to know that too. Because if a realtor is thinking, well, I could lower the price by 10,000 and get you a little bit of credit, how about we don't do either of those and just get me more credit? That's still better for the buyer. It just is.
Oh man.
The mortgage payment is less and the buyers are going to go for that. And any lender worth their salt can explain that to the buyer. So you as the agent need to, understand that your lender partners are here to help you win the deal. If you come to me and you say like, hey, there's 3 other offers in hand, how do we got to sweeten the deal? I'm going to tell you like offer 420 and get a $20,000 credit. Then the sellers don't care. They net the same, but our buyers get the win. Those other buyers, they're not going to be paying attention to that. And that's the secret. Everybody goes to price and they get all in a tizzy about it. I think it's a giant waste of time.
And then what tends to happen, especially with realtors, is they let the client lead them, right? You're letting the client lead you into a battle that could have been avoided had you just had the knowledge as a realtor to tell them, hey, once again, as a good realtor, because a good realtor is going to tell them what they don't want to hear. Hey, that's a bad idea. I know you've been told that this is how this goes and it's going to be some crazy knee slashing negotiation, but that's not what it is. We're gonna give them what they want, but we're gonna get what we want too.
Yeah.
Right. So I know that the numbers don't look good, but don't look at the numbers is what I'm telling you. Because the numbers, they don't matter right now. What matters is the concessions. And here's why. Right? You need to be able to articulate that to your clients because it's your civic duty to serve your clients in that way.
Yep.
That to be said, thank you so much for coming out,
Thanks
Kevin.
for having me.
Thank you, everybody, for watching. This is Rose City Realtor After Dark. I know it doesn't seem dark, right? We're in a basement.
We are.
No, we're in a studio, but it is a basement studio. But yeah, again, thank you so much for coming out from Corvallis. This is
Looking forward to
Kevin,
doing it again. This was great.
Kevin Silker.
Sliker.
God dang it.
I'll get it right by the
I'll
next
get it right. I'll get it. We got 6 more episodes.
Yeah, right.